Welcome back to Franco Dividend Investing. On this channel, I'm showing my journey on building a passive income stream through dividend investing, where I invest in well-established companies with a good track record of dividends increase. As well, I share my learnings and thoughts on personal finances, companies, and markets in general. On my personal example, I want to show that anyone can build an alternate passive source of income through dividend growth investing. Subscribe to my channel to see the development of the portfolio and leave your comments if you have any questions or suggestions. Today, I would like to bring a topic on how to invest without going broke. The investing is on the rise. With the recent mass spread of the information through articles, blogs, YouTube, and market bull run, almost everyone heard the story like, all you need to do is to put your money on the market and wait until it grows. So don't wait, invest from now until forever, and you will have a minimum 7% annualized rate of return. Especially when you hear from everywhere that market hit its historical highs every week. Look at this. November 2020. US stock hit historic highs again on Monday, where Dow closed at more than 27,000, S&P 500 more than 3,000, and Nasdaq 8,433 points. Then just a month later, another high, with Dow over 28,000 points, S&P 3,191, and Nasdaq 8,814. And the most recent, in January, Dow hits a new record, 29,000 points. And a lot of people buy it, so they invest whatever they can. But then unexpected events come. Trade wars, escalations in the Middle East or Eastern Europe, global medical emergencies. Market slows down. Media is full of the news. Is this another crash? People panic, and inexperienced investors sell their positions. This is no surprise that the average investor's return lag behind the economy. This chart compares the annualized return of various asset classes to that of the average investor. MarketWatch.com named it one chart that shows just how badly average investor lags, even cash. As you can see, the around 3% return earned by the most investors is even lower than the cash, 3 months treasury bills, and it barely beats the inflation. Why there is such difference between investors and all other sector and indices? The likely cause is that the majority of people are making the worst possible investing mistake, buying high and selling low. The fact is, many of us can't help reacting emotionally to geopolitical issues, exaggerated media stories, and poor market sentiments. Fear can push you out of the markets at the most inappropriate times. That's an instinct that you, as an investor, have to fight. On top of this, stop timing the entrance to the market. In a few illustrative pictures, I would like to show you what happens when investors wait for the best entry option. 3 friends, Tiffany, Brittany, and Sarah, decided to save $200 per month and invest their money in a low-cost S&P 500 index fund. Each one saved and invested over the last 40 years from 1979 until 2019, but each had a different market timing strategy. In total, each friend invested $96,000 over the course of the 40 years. Tiffany and Brittany knew the stock market could be volatile, so they tried to time the market and avoid the crashes. Rather than invest every month, they saved their $200 monthly investment in a saving account until they thought the time was right. And sure enough, over the period of investment, all experienced the 4 major crashes. These are the Black Monday on October 19, 1987, the first Gulf War from July to October 1990, the dot-com bubble that collapsed around March 2000, and the global financial crisis of 2008. Unfortunately, Tiffany always had terrible timing. She invested all her money the day before the 4 major stock market crashes of 1979 and 2019. But, and this is very important to notice, she never sold. Even with her terrible market timing, Tiffany's $96,000 turned into more than $660,000. Brittany also saved her $200 per month in a 3% interest savings account until she thought it was time to buy. She had much better luck or skills than Tiffany and always bought the market on the lowest day after each of the 4 major crashes. Thanks to her excellent timing, Brittany's $96,000 grew to $956,000. Sarah invests like I do: automatic, diversified, low cost, and simple. Rather than save her money and try to time the market, Sarah just threw her $200 per month into low-cost investments, S&P 500 index fund for the 40 years. Sometimes the market was overpriced when she bought, sometimes underpriced. But she continued to receive dividends through the highs and lows thanks to her consistent investment and ignoring the instinct to time the market. Sarah ended up turning her $96,000 of investment into more than $1,300,000. That's the power of continuous investment, ignoring the noise, staying the course, and allowing compounding interest to go to work. So my takeaway from investing without going broke is the following. Get yourself a steady monthly source of income, job or freelance, so you can cover your monthly expenses on housing, food, transport, all the others, and save some portion of your income. Pay out the debt, credit card, car or student loan. Build an emergency fund that equals to 6 to 9 months living expenses. This will help you to cover unexpected costs, keep you on a flow in case you need to change a job. This will be a buffer. In case things go bad, you don't need to sell your investments. Make research and invest consistently in things you understand. Now, back to my portfolio. As you can see, the capital gains were eaten by the market volatility. However, my projected dividends for 2020 have increased. I used the market slowdown to rebalance some of my early positions, J&J and 3M, and I added Enterprise Product Partners, or EPD, midstream natural gas and crude oil pipeline company, and Microsoft to the portfolio. As I have a cash pillow for unforeseen situations, from time to time, when the market slows down or drops, I'm able to deploy a higher amount to the investment portfolio compared to the usual monthly commitment. My portfolio consists of 17 companies and values over $6,200. The projected annual dividends are $138. So if I would stop investing right now, every year I would receive over $113 as a passive income. If some company from my portfolio cut or stopped paying the dividends, I would just sell that position and reinvest the cash into the other companies that continue to pay dividends. As I increase my portfolio, the future passive income will increase as well. So hopefully one day I can live from it. This will be it for this week. Subscribe to my channel to see the development of the portfolio and leave your comments if you have any questions or suggestions. Thanks, and see you next time.